and welcome to this week's episode of Crack the Code. I'm Sumaira Abdi. Our focus today is on the fast-moving consumer goods sector, or FMCG.
It's a sector that is attracting marketeers across the world due to its huge growth potential. Global FMCG players already have a strong presence in India, with a renewed focus on rural India. A recent study by the McKinsey Global Institute suggests that if the country continues to grow at the current pace, average household incomes will triple over the next 2 decades, making India the world's 5th largest consumer economy by 2025, up from the current 12th position. This should be music to the ears of FMCG players. Over the last 1 decade, this sector has clocked an annual average growth rate of 11%. Various studies indicate that during 2016 to 2020, the FMCG market in India is expected to grow at a compound annual growth rate of 20.6% and reach the $103 billion mark by 2020.
So given this backdrop, the FMCG sector seems to look very promising. But is it indeed? What is this seen at the ground level? Well, to guide the investors, I have with me Gautam Benjamin of ICICI Securities, VK Sharma of HDFC Securities, and G. Chokalingam of Economics Research and Advisory. Gentlemen, thanks very much and welcome to the show. Benjamin, my first question to you, because you have a background in investment banking, right? So you have your pulse on what a lot of people within various sectors are doing. So tell us, is there value still left in the FMCG space? Because, historically, the FMCG index has just about paced the Sensex, right? So it's been a defensive part of somebody's portfolio. Is there value now for the next 10, 20 years?
I certainly think so. I mean, if you look at it, the FMCG sector, which is roughly a $50 billion market today, is expected to double over the next 4 or 5 years. And clearly there is a lot of tailwinds to sort of support that growth, whether it's GST, whether it's a good monsoon this year, or, commodity prices are relatively low. So there are a number of tailwinds actually sort of supporting that kind of growth. So I think certainly, yes, there is an opportunity to invest in the sector. And I think it will, in an overall context, outperform what it has done in the previous 10 years.
So it's interesting that you say there are tailwinds because, there are headwinds as well, right? So there's muted consumer sentiment, competition is coming in from the likes of Patanjali. So how does one actually play this theme then over the longer term?
Very interestingly, what has happened, if you analyze last 10 years of data, say top 15 FMCG companies, including MNCs and Indian companies, one major structural change is that the Indian companies have grown faster than the MNCs. In fact, their sales have grown almost 7-fold in the last 10 years, when FMCG have grown only around 3 times. And similarly, even if you look at the operating profit, the domestic companies have grown much faster. And even the wealth creation by domestic companies is much faster. In the last 10 years, the market cap has gone up by 800%, whereas MNCs have gone up only by 400%. So point A, the competition got intensified from the domestic companies. 2, on the top of it, now you have got a Patanjali. And third, all of us know the kind of slowdown we have seen in the economy, which is affecting, and apart from that, 2 consecutive monsoon failure. Fourth, what has happened in the last 10 years, thanks to the advent of electronic media and the proliferation of regional TV channels, there are a lot of regional brands which have emerged in the FMCG category. So that is also hitting, the whole pack. Finally, the valuation comfort is not there. I mean, except the ITC, you don't find any valuation comfort. Therefore, there are many headwinds going ahead, but still they would remain as a good, defensive. But the quantum of, the wealth creation from such a defensive phase is now limited because of these 5 reasons.
Yeah, that's true actually. Vicky, so I want to get to the stock-specific action then, because we have an HUL where valuations are high. Something like an Asian Paints has been a mega wealth multiplier for investors. How does one actually play this now? I mean, even within the FMCG retail basket, what are the sections for an investor to look at?
One common thing that people tend to do is they look at the sector as a safe sector. That is not the case. You need to look at individual players. Within this, Asian Points, as you pointed out, has given you a CAGR returns of around 25% for the last 20 years. And the past 10 years have been still better. 34% return CAGR for the last 10 years. So you will not get value price in these stocks, but you need to be invested in these stocks because you need to go after growth. So that growth will come higher growth will come in the paint industry, which is because this is the domestic player, largest of them all, and continuously innovating. So you'll always find Asian Paints as not a cheap stock, but definitely a good bet even at this rate for all years to come, even for the next 5 years.
Yeah, that's a good point actually, because after all, India is a consumption-driven story, right? But there's this dichotomy that's now emerging, because while a lot of people, Benjamin, are saying that, oh, we're betting on the India growth, and India growth is the story of the future, there are as many warnings coming in, right? So Unilever recently has warned on their outlook for India. How does an investor actually look at this dichotomy? I mean, does he stay put in FMCG?
If you look at companies like Unilever, they're, the warning has come also because a large part of their focus is on very highly competitive segments, whether it's, soaps or detergents or what have you. But there are a lot of new segments which are sort of, coming into prominence, where there are, opportunities to play. Plus, even in the core areas, a lot of the Indian companies, for example, are looking at expanding overseas. A number of the Indian players have expanded to Southeast Asia, to Africa. There could be opportunities out there. In fact, those have become very large parts of companies' turnovers, anything from 15 to up to 50% in the case of Godrej. So there are micro stories out there that one needs to look at, and not necessarily paint the entire FMCG sector because Unilever has a concern on their growth.
That's true actually, although I have to admit there is some bit of partiality when Unilever comes out with a statement. You do tend to look at the entire sector through that lens. But Mr. Chokalingam, even within the space, right, so if you look at the urban play or the rural play, we're seeing now that the urban play is not seeing that much traction, right? While the luxury or the premium segments are actually registering the bigger growth. Is that where a person's money should be, in the premium segments or the branded products?
Certainly. I mean, again, I would say that with a defensive approach you can keep. To add a point to this dichotomy, what has happened is that as I mentioned earlier, 2 consecutive monsoon failure has impacted the rural. But in urban case, what has happened? The penetration has already peaked out. Even in the low income strata, the FMCG products have penetrated. Yeah,
but I mean, just to counter that argument, auto sales, for example, is still doing well, right?
Very interesting point, but there is a huge difference. If you take for example, toothpaste in an urban center, I am sure the penetration would be as much as 90%. But whether you take a urban center or whole Indian economy, if you take the penetration of car, the few years ago it was estimated that only 10 households out of 1,000 households had car. So the penetration, the difference in the penetration level is huge. That is not the case with FMCG. It's very high. Whereas in automobile it is still too low, even after this robust sales of automobiles. And there is enormous competition now. So that is why in the last 2 years when the oil price crashed, most of these companies like HUL and all, they had to pass on the benefit of the cheap raw material. They were not able to take it on their profit and loss account directly. So that is what reflected even in the profit growth. And a very interesting point is that if you look at all FMCG companies, whether you take a rupee revenue or volume growth, most of them are in single digit. These are not seen in the last 10-15 years. So therefore we have to live with this limitation on the growth for the entire space going forward.
What's the lesson for an investor from, say, a Nestle story, right? I mean, there was a time when nobody would recommend it, nobody wanted to touch the stock, and yet it has bounced back, not just from its failures, but also from an investment point of view, right?
I think among established players, if they give you an opportunity, like Nestle gave, its stock fell almost 26% over a few months from its early high of May 2015. And subsequently, if you had bought even at that level or subsequently even at lower levels, averaged it out, the stock would have given you 50% returns from the bottom. Before that event actually played out in Nestle, you had Lever and Nestle both. The returns today, even after the fall, today the return is the same in both the stocks.
Benjamin, in the primary space, this dairy has actually been creating quite a buzz, right? So there have been 2 big IPOs, Prabhat Dairy, Parag Milk. Quality is back on investors' radar. What's so attractive about this segment? I mean, should retail investors be taking it seriously?
See, the basic macro out here is one of protein consumption. Being a largely vegetarian society, milk is the best sort of supplier of protein. The second thing is the move from loose to a packaged form. And we're seeing a lot of that. And as it is, the market is very large because at I think 60 million tons, it is the largest or the second largest market in the world. So, these are two very fundamental events which are happening within the dairy segment to make it a very, very attractive play going forward.
What about the e-commerce theme then? How does one actually play it? Because that's top of mind, right? Do you play it through logistic companies? Do you play it through branded products? What's the best way?
Just step out of your house, within 100 feet distance you get a shop. If you have to buy a computer or any durable, then it's a journey to long distance. So that makes a big difference. So therefore, for e-commerce, I would not play on FMCG. I would play more on, the durable, consumer durables.
I think there is slight change here. I beg to differ. While world over, the internet sales accounted for only 5% in 2015, in India it is 1 to 2%, but it is picking up. Last week, I wanted a drink. I didn't get in my store. I ordered on Amazon their grocery, and within 2 hours the brand was with me. So this experience will change it. How good your ability to keep pace with the times will determine the success in the new era.
Now that we're talking about ordering, that brings me to quick service restaurants, right? Jubilant Food has had a turbulent time of late. Yum Brands, though, their latest numbers for India show that there's some growth. Same-store sales are picking up. Is there any scope for investors to actually be putting money here?
It's a large space. I mean, it's $20 billion in size as per some estimates, and it's poised to grow at a very, again, double-digit rates. Having said that, there are very few brands which are truly established in that space and to make a mark and really investable because they're not sort of listed. So I think it's a space to watch out for. I'm not sure if there are a lot of investable opportunities except for a couple of them in this space. Also,
we hear now that this DMart IPO might be coming, right? Is that something that retail investors or value investors, VK, should be looking at very, very seriously? I mean, it's not yet announced, but it's on the card.
Definitely, an IPO should always be compared with that what is the price at which it is coming and is there any listed peer available. So depending upon the kind of profit that you may have on the table, I think it will have a huge appetite, and the success of the issue will be a function of what is the amount of money that is for me as an investor. Definitely one should look at, compare it and then apply.
Yeah. And Mr. Chokalingam, do you concur with this view?
There is a bubble in many post-IPO listing. And also the valuation upgrade has already happened in the retail space. So definitely if valuation is reasonable, definitely one should apply and make use of it.
The only reason I ask actually is because of this strong promoters, right? Speaking of leadership then, is a good leadership at the top? I mean, it's at the top of pyramid, right, for a value investor. But is that enough? Is there more that a person should be looking at?
I think it's very important that they continue to practice good investor relations, because even established brand, Gillette is the best brand. It was known as Indian shaving products in India, and at that time they merged their Duracell unit, a loss-making Duracell unit, on the basis of sales. This is pathetic. The stock tumbled almost 80% in the next 1 year from that. And the same management then later on became good by when it introduced let's say a preference share capital issue of 100 crores at 0.5% interest. That means the management is now really willing to bring some value to the company, because they could have very well increased their shareholding, or they could have brought in debentures which at that point of time carried interest rate at the rate of 14%, but they preferred to have 0.5%. So that means, and that stock then multiplied another 7 times in the next 2 years. So a good management always needs to be measured by its practices.
Tell us about the companies themselves, right? So if as a retail investor, I'm looking at an FMCG company, is it advisable for me to look at companies which have multiple product lines, say like an ITC, for example, or should one focus on companies which have a single focus towards one product?
They both have their time and place. In a period of high growth, obviously being focused on one segment does help, as opposed to being spread across the spectrum. I would personally, if were to invest in a company that had a more diversified portfolio, I think that would be a safer approach to catch the growth on a more long-term basis as an investor?
The durability of the growth and the margin. Today that is at the stake for many people. Like if you talked about the dairy segment, you have to understand the fact that the key raw material is milk. In many states which is controlled by the government, and they fluctuate widely, the prices, even the availability. So therefore, you have to look at durability, whether it is a diversified, whether into dairy or other FMCG. So the durability of growth, sustainability of the margin, apart from the management quality and balance sheet strength. So these are the core parameters one has to watch out, and of course the valuation multiple to make a wealth in this space.
Okay, so in that case, tell us, for an investor, do they look at what's the most important metric? Is it margins? Is it margins or is it volumes? Is it volumes at the cost of margins, vice versa? Does the ad spend actually translate to their top line? And if it is, like VK mentioned, that that's a complete avoid. What's the most important metric for an investor?
Yeah, certainly. Very simple. The retail investors need not break their mind with so many parameters. Just to look at the volume growth, and it gets reflected in the value of sales. So irrespective of the market conditions, industry condition, if some company can grow the top line and without losing anything on the margin and grow the profit also in double digit, that's the best pick.
Vicky, going forward now, are there any undiscovered names left in FMCG? If a value investor has to put in money today, do they have to just wait for a dip, or is there anything out there, a story which has not yet been told?
The stories are not going to happen overnight in this sector, but regulatory changes could bring in some kind of surprises. For instance, tomorrow if they were to allow, like FSI, they are internally discussing it, that they would allow iron to be added to atta and other commodities. So this commoditized product could become value addition. So in this space, there is room for players who are in this segment, not where this particular product would be a good portion of their sales. I think those companies one can look at.
Yeah, I know. I think every budget, all the ITC investors wait by and see if there are going to be any excise changes or not. But all right, then just to wrap it up, Benjamin, any words of advice then for investors who are looking to pick up FMCG companies? Anything that they should be looking out for?
Well, I think my top 3 criteria would be management quality, volume and margin sort of consistency in terms of growth. And finally, I'd also look at return ratios. They're sort of a function of the first 2, but I think return ratios are also critical in this.
Mr. Chokling?
Yeah, there are 2 ways one can look at for making money still in FMCG space. Like if you recall 2013, overnight HUL got re-rated. So who knows, tomorrow ITC may be re-rated. So one has to take a call, the visionary call. And second, there are many small micro cap stocks in FMCG space also. Some of them are already rewarded. So definitely one can look at these kind of stocks very carefully and have 3 to 5% exposure in the whole portfolio.
Okay.
India is definitely a growth story, demographic story. Population is increasing. Number of people, nuclear families living out of their joint families is increasing. So therefore, you'll need to paint your house, paint each wall differently. So paints is definitely one segment of that which will grow, on which there are no 2 doubts that it will continue to grow at a faster pace than the other parts of the FMCG industry. Here you don't have to experiment. At the most, if you want to average out, maybe I'll average out lower.
All right. On that note, gentlemen, thanks very much for being a part of our show, and thanks very much for educating our investors.
Thank you so much.
All right, so that brings us to the end of this show. Do stay tuned as we continue on our quest to decipher and analyze so that you can invest wisely. Until next time, thanks for watching.
Focus, ideate, innovate, enable.